Every reserve currency in history dies the same way, slowly at first, then all at once. And the frightening truth is this: the US dollar has already stepped onto the same timeline that destroyed Portugal's real, the Dutch guilder, and Britain's mighty pound. Most people still believe the dollar is invincible, but history is merciless toward empires that mistake momentum for immortality. And if you've studied the 7-stage reserve currency death cycle, you already know the dollar is deep in stage 5, not approaching it, not flirting with it, already inside it since 2008, when quantitative easing became America's economic religion. But the real story begins now, because history doesn't just tell us where we are. It tells us exactly what comes next, not metaphorically, not vaguely, but year by year, event by event, collapse by collapse, a timeline carved into centuries of financial destruction. In stage 6 is where the countdown truly begins. Context: the lessons empires ignore. When historians map the fall of reserve currencies, they always come back to 4 nations: Portugal, the Netherlands, Britain, and now the United States. Across 600 years, these 4 civilizations experienced the same rise, peak, stagnation, and collapse. And whether their flags flew over oceans or their banks ruled global trade, every one of them entered a final irreversible decline that took 10 to 20 years from the beginning of stage 5 to the end of stage 7. Portugal, 15 years. Netherlands, 18 years. Britain, 22 years, average 18 years. And the dollar? It reached stage 5 in 2008, when the global financial system hit cardiac arrest and the Federal Reserve performed an unprecedented experiment in monetary creation. 17 years have passed. The countdown window has opened, and unlike past transitions, this one is happening in a hyper-connected, hyper-leveraged world where money moves at the speed of light, and crises move even faster. A British merchant in 1949 needed weeks to escape a currency collapse. A modern investor? Milliseconds. That is why the coming transition may unfold more violently and more suddenly than any before it. But to understand where the dollar's going, we must return to the most recent and best documented collapse: the fall of the British pound from 1945 to 1967. Because Britain's stage 6 and stage 7 are not just historical curiosities, they are the roadmap for the dollar's next decade. Pattern reveal. Stage 6. The world loses faith. Economists give stage 6 a deceptively mild name: loss of confidence and search for alternatives. But what it really means is this: the world realizes the empire is aging, its debts are unsustainable, its currency is overvalued, and the global system quietly prepares its exit. This is exactly what happened to Britain in 1945, ironically at the very moment it emerged victorious from World War II. It had won the war, but lost its economy. Industrial base shattered, empire fracturing, massive war debts owed to the US, an artificially strong currency supported only by American loans. The pound still had the prestige of being the world's reserve currency, a status it held since 1815, but prestige cannot defend an overvalued currency. In 1945, the pound was fixed at $4.30, a rate that existed more on paper than in reality. Britain needed a $3.75 billion loan from the US, not to grow, not to invest, but simply to avoid immediate collapse. But there was a catch. The pound had to become fully convertible within 1 year, meaning foreigners could exchange pounds freely for dollars. This was America's way of testing whether Britain's currency had real strength or whether its power was just a memory. In 1947, the world got its answer. The moment convertibility opened, everyone rushed for the exit. A 6-week run on the pound wiped out a quarter of Britain's dollar reserves. Within 42 days, the crisis forced the government to suspend convertibility entirely. The message to global markets was unmistakable: the pound is weakening, the empire is fading, trust is slipping. But the moment that truly shattered confidence came 2 years later. The first crack: Britain's 1949 devaluation, September 1949. Britain finally admitted what markets already suspected: the $4.30 exchange rate could not be defended. The government slashed the pound's value to $2.80 overnight. a devastating 30% devaluation that instantly vaporized wealth. If you held pounds, you lost 30%. If you held British bonds, you lost 30%. If you held UK savings, you lost 30%. And this wasn't a one-off. It was the first signal of what happens in stage 6. Once a reserve currency devalues, confidence dies. And once confidence dies, capital flees. And once capital flees, the end becomes inevitable. Throughout the 1950s, central banks quietly shifted from pounds into dollars. Not a panic, not a mass exodus, but a steady, deliberate migration, exactly the pattern monetary historians see before every collapse. By 1955, the US dollar overtook the pound, and Britain's global dominance was gone. But the world didn't see the real break until 1956, during the event that revealed Britain's true status not as a global ruler, but as a dependent ally. The Suez Crisis. When everyone realized the empire was over in 1956, Egypt nationalized the Suez Canal, a lifeline for British trade. Britain responded the only way an empire knows how. It prepared to take it back by force, alongside France and Israel, but the United States objected. President Eisenhower threatened to crash the pound by dumping British bonds unless Britain withdrew, and Britain obeyed. It was a global humiliation. The empire that once policed the seas could no longer secure a canal without Washington's blessing. Markets absorbed the humiliation quickly. The pound fell again. Capital quietly flowed out. Britain began introducing capital controls, trapping money inside the country. And this is the moment every reserve currency eventually reaches. When a nation must trap its own citizens' money to keep the currency alive, the currency is already dying. By 1960, it was obvious to insiders in central banks worldwide. The pound was finished. Stage 7 was close. The end was coming. Outrow, the warning that almost everyone ignored. Britain's stage 6 lasted 15 years. 15 years of warning signs. 15 years of opportunities to exit. 15 years where the elites quietly diversified while ordinary citizens trusted government assurances. And history shows the same tragic pattern. Most people ignore stage 6. Only a few prepare for stage 7. And when stage 7 arrives, the destruction is sudden, violent, and irreversible. In the next part, we enter Britain's stage 7 and the brutal consequences that followed. Because once you understand what happened in 1960, 1967, you will understand exactly what awaits the dollar. And the parallels are far more direct and far more urgent than people realize. Stage 6 is long, quiet, deceptive, a slow bleed, a polite decline. The empire still looks powerful. The currency still circulates. The charts do not show catastrophe yet. But then comes stage 7. And stage 7 is not slow. It is not polite. It does not whisper warnings. It erupts, tearing through the economy with the force of a financial earthquake. Britain crossed this threshold in 1960, and for 7 brutal years, from 1960 to 1967, the pound spiraled into a collapse so violent that it erased nearly a century of financial dominance. This is the part of the timeline ordinary citizens never see coming, and this is where the United States is heading next. Context: Stage 7 begins. Capital flight, controls, and collapse. Stage 7 starts the same way in every empire. The smartest money leaves first. By 1960, wealthy British families and corporations understood what was coming. They had watched the Suez Crisis. They had witnessed the 1949 devaluation. They had seen central banks abandon the pound. So they didn't wait for permission. They moved. Assets quietly transferred to New York Bank's pounds exchanged for dollars, and Swiss francs gold, purchased through foreign intermediaries' investments, relocated overseas. London bankers, ironically, assisted the exodus, helping elites shift capital abroad long before the public noticed anything was wrong. This is the pattern every dying currency follows. When the insiders flee, governments respond not with reform, but with controls. And Britain did exactly that. The government introduced increasingly strict capital controls, limiting how much currency citizens could take out of the country, restricting foreign investments, and requiring official approval for many types of cross-border transactions. These controls were supposed to protect the economy, but to global markets, they proved something far more dangerous. Britain no longer trusted its own currency, and once a government must trap capital to save its money, the collapse has already begun. Pattern reveal: the IMF bailout in the final slide. By 1964, Britain was hemorrhaging reserves at a pace no country could survive. Foreign investors were selling pounds faster than the Bank of England could defend them. British policymakers chose the only path desperate nations always choose. They went to the International Monetary Fund. For an empire that once ruled half the planet, this was humiliation on a global stage. The world watched as Britain, the former financial center of the world, stood in line asking for loans like a struggling, developing nation. The IMF bailouts bought time, but not stability, because Stage 7 has no reverse gear. Britain tried everything: raising interest rates, cutting government spending, negotiating more loans, pleading for international support. Nothing worked. By 1967, the world already knew the truth. The pound was doomed. Britain was only delaying the inevitable. Then in November 1967, the breaking point arrived. The shock: 1967 devaluation. The currency dies. The British government announced the second major devaluation, from $2.80 to $2.40, a 14% loss. Instant, irreversible. For the second time in a generation, savings were vaporized overnight. But the number alone doesn't tell the whole story. This wasn't just a currency weakening. This was an empire accepting its fate. The message was global and brutal. Britain could not defend the pound anymore. More devaluations were coming. Anyone still holding pounds would lose everything. The aftermath was devastating. Imported goods surged in price, oil and food costs spiked, inflation accelerated. The British middle class saw purchasing power implode. Bondholders lost money from both inflation and currency collapse. This is why Stage 7 is catastrophic. You don't just lose 10% or 20%. You lose most of your wealth, slowly at first, then violently. Let's look at the numbers in real terms. The math of ruin: how the middle class was wiped out. Imagine you were a successful British professional in 1945 with $100,000. A fortune then, equivalent to around $400,000. Here is what happened to you during Stage 7. By 1967, after 2 devaluations and persistent inflation, your wealth had shrunk to the equivalent of $130,000. But in dollar terms, your wealth had collapsed by 67%. And by 1980, due to the inflation storms of the 1970s, that same 1945 fortune was worth roughly $50,000, an astonishing 87% loss. This is what dying reserve currencies do. They erase generational wealth. They punish savers. They bankrupt retirees. They destroy the middle class. They reward only those who escape early. By 1970, it was over. The pound no longer functioned as the world's reserve currency. Global trade had fully shifted to the US dollar. Britain remained important, but no longer dominant. The empire had fallen silently, not on a battlefield, but in the balance sheets of central banks. Modern parallel: where the dollar stands now. And now we return to the modern world, because every stage of the British collapse is being mirrored, almost line for line, by the United States. The timeline is shockingly close. Dollar entered Stage 5 in 2008. We are now approaching the Stage 6 to 7 window. Global powers are diversifying away from the dollar. Nations are forming rival currency blocks. Capital controls, once unthinkable in America, are openly discussed in policy circles. And just like Britain in the 1950s, the United States still looks powerful, still looks unshakable, still believes its status is untouchable. But prestige is not a shield, and history is not sentimental. Every empire thinks it's different. Every empire thinks it's exceptional. Every empire thinks it will be the first to escape the pattern. None ever have. Britain didn't, the Netherlands didn't, Portugal didn't, and now the United States stands where those empires once stood, at the edge of Stage 7. But before we map the dollar's projected timeline from 2025 to 2045, we need to understand something even more important: the hidden timeline, the one the public never sees, the one only insiders understand. Because during Britain's collapse, the wealthy weren't just watching, they were acting. quietly, deliberately, successfully. That hidden playbook still exists, and in the next part, we uncover it. Every collapse has two timelines. The public timeline, filled with headlines, government speeches, and visible economic cracks. And the hidden timeline, the quiet actions taken by the top 1% long before the crisis becomes undeniable. During Britain's fall from 1945 to 1967, ordinary people watched the news, but the elites watched the indicators. Ordinary people trusted the government. Elites trusted history. Ordinary people kept their savings in pounds. Elites moved to dollars, gold, and foreign assets years, sometimes decades, before the pound collapsed. And now, as the US dollar enters stage 6, the same divergence is happening again. Those who understand the pattern are already preparing. Everyone else is still arguing about whether the dollar can fall. But stage 6 doesn't wait for consensus. It only waits for confidence to break. Context: Britain's hidden timeline, 1945-1960. While newspapers celebrated Britain's post-war recovery, high net worth families, corporations, and institutions quietly executed a long-term exit strategy. This timeline reveals exactly what the most informed economic actors were doing. 1945-1949. The early exit. The elites saw the writing on the wall. Britain's war debts, America's rising dominance, a massively overvalued pound, a fragile empire held together by loans. Between the lines of official speeches, analysts saw something terrifying. The reserve currency was living on borrowed time. London's financial houses began quietly setting up trusts in New York, US-based corporate subsidiaries, dollar-denominated bond portfolios, gold positions through Swiss intermediaries. They weren't running from Britain. They were running from the pound. 1949-1956. The shift accelerates after the 30% devaluation in 1949. The smartest money accelerated its exit. Dutch banks shifted reserves from pounds to dollars. Middle Eastern sovereign wealth moved into gold. British corporations began reporting profits in dollars. International trade contracts slowly denominated in dollars instead of pounds. The trend was subtle, but relentless. By the time the world reached the Suez Crisis in 1956, the insiders were fully convinced the pound's dominance was finished. And while the public watched battles in Egypt, the elites were watching the Bank of England's reserve position crumble in private reports. 1956-1960, the final warnings. These were the years where insiders knew collapse was coming. Indicators they tracked included accelerating reserve losses, rising foreign claims on the pound, falling confidence in British debt, America's increasing influence over global trade, capital control proposals debated behind closed doors, and while ordinary citizens were saving in pounds, the elite were already beyond it. Their wealth sheltered, diversified, protected. The lesson is brutal but simple. The rich don't predict collapse, they prepare for it. The poor don't prepare for collapse, they deny it. Pattern reveal. The dollar enters the same script. Now the world is living through the dollar's stage 6, and every signal that marked Britain's decline is once again flashing. But this time the signals are bigger, faster, and global. Indicator 1, great powers exiting dollar reserves. Since 2014, China's dollar reserves have dropped sharply. Russia eliminated nearly all of its U.S. Treasury holdings. Turkey, India, Saudi Arabia, and Brazil have reduced dollar exposure. This is not speculation. This is documented, quantifiable capital rotation. It mirrors the 1950s when central banks silently reduced pound holdings before the collapse. Indicator 2, the petrodollar system breaking. In 1974, Saudi Arabia agreed to price all oil in dollars, cementing the dollar's reserve currency status. In 2023, that 50-year agreement effectively ended. Saudi Arabia started accepting UN rubles, other local currencies. This is not a minor policy change. It is the equivalent of Britain losing control of the Suez Canal, a geopolitical signal that the empire's reach is fading. Indicator 3, gold purchases at record highs. Central banks are buying 1,000 plus tons of gold per year, the highest since the 1950s. This mirrors the exact pattern that preceded Britain's collapse, when countries replaced pound reserves with gold and dollars. Gold is not a speculative play here. It is a quiet vote of no confidence. Indicator 4. Emerging currency blocks. BRICS isn't just a diplomatic group anymore. Brazil, Russia, India, China, and South Africa, 25% of global GDP, are openly building a reserve currency alternative backed by commodities, energy, minerals, digital settlement systems. During Britain's collapse, alternative blocs whispered about change. Today, they announce it on global television. The shift is louder, faster, and more coordinated than anything Britain ever faced. Modern parallel. The dollar's stage 6 timeline, 2025-2033. Based on Britain's collapse and the mathematical pattern across all reserve currencies, stage 6 for the dollar unfolds in 3 phases. Phase 1, 2025-2027, the quiet unraveling. This is where the signs become undeniable to analysts, but invisible to the public. Expect global trade deals in local currencies, slow but steady reserve diversification headlines about rebalancing portfolios, increasing gold purchases, quiet discussions in central banks about alternatives. The dollar's share of global reserves will fall from 58% to 50%. This drop seems small, but represents trillions of dollars slowly exiting the system. Phase 2, 2027-2029, the first dollar shock. Every collapsing currency experiences a moment equivalent to Britain's 1949 devaluation. For the dollar, this may come from a U.S. debt crisis, a failed bond rollover, a geopolitical rupture, the Fed losing control of inflation, a global shift away from dollar trade invoicing. Expect a sudden 15–25% drop in the dollar's value. This is the turning point. After this event, the decline accelerates. Phase 3, 2029-2033, the tightening trap. This is where the government does what all dying empires do: implement capital controls, restrict large foreign transactions, pressure allies to hold U.S. treasuries, quietly limit outward flows from banks, and force temporary emergency measures. These controls will fail. They always fail. But their presence signals the approach of stage 7. By 2033, the dollar will hold less than 40% of world reserves. This is the threshold where reserve currency status is effectively lost. The empire still stands, but the currency has already fallen. Outro, the hard truth, stage 7 is no longer distant. The United States is approaching the same point Britain faced around 1960. The difference? Britain's collapse was slow. America's will be fast. A globalized digital economy accelerates every failure point. Capital flight currency shocks systemic contagion, geopolitical responses, inflation spirals. And now that we've mapped a stage 6, we must enter the darkest chapter. Stage 7, the currency crisis, the devaluation event, the replacement, and the destruction of accumulated wealth. This is where history stops suggesting and starts repeating. In Part 4, we walk step by step through the projected collapse of the dollar from 2033 to 2045, a timeline more brutal than Britain's, and far more consequential for the world. Stage 6 is denial. Stage 6 is debate. Stage 6 is the lull before the hurricane. Stage 7 is the hurricane. It is the moment when every warning ignored becomes a consequence suffered. When wealth evaporates not over decades, but overnight. When the world's former financial anchor becomes the epicenter of global turbulence. For Britain, stage 7 lasted from 1960 to 1967, 7 unforgettably brutal years. For the United States, stage 7 will likely unfold even faster, because today's world is more interconnected, more leveraged, and more vulnerable than at any point in financial history. And now we project the timeline, based on patterns that have never once failed across 600 years. Context: the beginning of the crisis, 2033-2035. Stage 7 begins the same way in every empire. The government loses control. In Britain, this moment came when policymakers could no longer defend the pound's value, despite emergency measures, foreign loans, and IMF support. For the US, the trigger window is 2033-2035, the period when reserve diversification accelerates global trade. Invoicing shifts out of dollars. Capital controls begin tightening. The new commodity-backed alternatives gain traction. Foreign creditors demand higher yields to compensate for dollar risk. These factors converge into a crisis that can no longer be postponed with speeches, stimulus, or interest rate adjustments. And then the breaking point arrives. Pattern reveal. The first major dollar devaluation. In Britain, the breaking point was November 1967. The pound collapsed from $2.80 to $2.40 overnight. For the dollar, the equivalent event is likely a 20–35% devaluation between 2033 and 2035. This can be triggered by a failed U.S. Treasury auction, a sovereign credit downgrade, a worldwide shift into commodity-backed settlement systems, loss of confidence due to inflation or monetary instability, a geopolitical fracture that splits global trade spheres. Whatever the spark, the outcome is predictable. The dollar drops by a third. Global markets panic. America enters its 1967 moment. If you hold dollars, your purchasing power collapses. If you hold dollar-denominated assets, their global value plummets. Bondholders suffer a double blow. Falling currency, rising yields, and imported goods, energy, food, electronics, explode in price. This is not coincidence. It is mathematical inevitability, because a reserve currency is not just a medium of exchange, it is a promise of stability. When that promise breaks, everything breaks. The aftershock: inflation, controls, and social tension. Following the devaluation, the United States faces the same triad every collapsing empire faces. 1. Inflation. Spike import prices surge. Energy costs explode. Manufacturers pass costs on to consumers. The middle class loses purchasing power faster than wages can adjust. Inflation doesn't creep. It jumps 5%, 9%, 12% in a matter of months. 2. Emergency government measures. As panic spreads, the government responds with the same tools Britain used: price controls, capital controls, temporary bank withdrawal limits, restrictions on overseas investment, foreign exchange, monitoring emergency stabilization acts. These measures are always presented as temporary. They never are. 3. Social unrest and political instability. When people wake up 30% poorer, they protest. When retirees lose decades of savings overnight, they revolt. When essential goods become unaffordable, unrest becomes inevitable. Britain experienced strikes, public anger, and political upheaval. The United States, far larger, more polarized, armed, and globally connected, will face this at a magnified scale. Stage 7 does not break quietly, it breaks loudly. The transition, the new reserve currency, 2035-2040. Every collapse ends with the same question: what replaces the fallen currency? When the pound fell, the US dollar was ready. It had strong gold backing, pre-1971 industrial dominance, geopolitical influence, a stable banking system, deep bond markets. But when the dollar falls, there is no single heir, no single empire with both economic strength and global trust. So the replacement will likely be a system, not a country. Based on today's trends, the most probable successor is a BRICS plus commodity-backed currency basket, structured as a digital settlement layer partially gold-backed, supported by oil, natural gas, rare earths, and key minerals, audited, transparently governed by a consortium rather than a single nation. This system isn't fantasy. It is already being discussed publicly. And because global trade is accelerating toward multipolarity, the new reserve standard will be more decentralized, more commodity-linked, more transparent, more resistant to political manipulation. Between 2035 and 2040, this new system takes shape and expands. Oil pricing shifts, global commodities move to the new benchmark countries, diversify their reserves, international contracts, reprice alternative payment networks, surpass SWIFT dollar dependency, shrinks to regional usage. And slowly, then suddenly, the dollar becomes the new British pound, important domestically, secondary internationally. The final years. Stabilization at a lower level, 2040-2045. By 2040, the global monetary transition nears completion. The dollar still exists, but with a drastically reduced role. Expected outcomes: 65 to 80% decline in dollar purchasing power versus gold or the new reserve asset. U.S. living standards decline relative to Europe, and Asia imports remain permanently more expensive. Budget deficits require real payment, not money printing. The Federal Reserve loses its global policy reach. Foreign investors demand high yields for any dollar lending. American foreign influence shifts from financial to strategic and military domains. This is not the end of the United States, not even close, but it is the end of a privilege the country has enjoyed since 1944. The privilege to print the world's currency and export inflation to everyone else. No empire has ever regained reserve currency status once lost. Portugal didn't, the Netherlands didn't, Britain didn't, and the US will not either. The global system will rebalance. The US will adapt, but the age of dollar supremacy will be over. Outro. The question that determines who survives. The collapse of a reserve currency is not the collapse of a country. It is the collapse of wealth stored in the wrong form at the wrong time. Those who survive are never the ones who wait for official announcements. They are the ones who recognize the patterns. Stage 6 gives warnings. Stage 7 delivers consequences. And now that we've mapped the full collapse timeline, the final question is simple. How do you prepare? How do you position yourself so you're not destroyed by the transition, but protected and even strengthened by it? If there is one lesson that repeats across 600 years of monetary history, it is this: reserve currencies die, but people don't have to die with them. Portugal's elite survived the real's collapse. Dutch bankers survived the fall of the guilder. British wealth quietly migrated during the pound's decline. And today, as the dollar approaches stage 6 and stage 7, the same opportunity exists again. The majority will lose everything, not because the collapse is unpredictable, but because they refuse to accept the pattern. Those who survive, they follow the same timeless playbook, unchanged across centuries. Context: the universal laws of surviving a currency collapse. Across 4 major reserve currency deaths, the behavior of the elites was shockingly consistent. It can be distilled into 3 universal laws. 1. Do not hold all your wealth in the dying currency. This sounds obvious, yet it is the mistake 90% of people make. The Portuguese who died financially were the ones who held real. The Dutch who suffered held guilder bonds. The British middle class was wiped out because they held pounds and gilts. When stage 7 hits, currency-based assets are not a store of value. They are a slow-motion fire. The elites always diversify before the crowd notices the smoke. 2. Move into real assets and hard money gold. Land, productive businesses, and essential commodities have survived every collapse. Gold is especially critical. It is the only asset that outlives every currency, is accepted across borders, has no counterparty risk, cannot be printed, rises during devaluations. In every case, from Portugal to Britain, those who held gold preserved their wealth while the currency disintegrated. 3. Position. Globally, not nationally, empires fall inwards. But wealth survives outward. British aristocrats moved assets to New York. Dutch families shifted to London. Portuguese merchants diversified into Spanish silver. American elites today are buying assets abroad, opening accounts in Switzerland, Singapore, and Dubai. The lesson? You do not survive a collapsing empire by staying inside its financial walls. These walls are built to trap wealth, not protect it. Pattern reveal. The practical steps the elite took, and you must take. Let's break down the elite survival strategy into concrete actions, based entirely on historical evidence. 1. They diversified internationally before the crisis became visible. In Britain, corporations shifted earnings to dollars in the 1950s. Wealthy families set up trusts in the U.S. Banks quietly increased foreign exposure. This is happening again today, with wealthy Americans shifting assets to Swiss francs, Singaporean banks, Dubai family offices, foreign real estate, gold stored abroad, dollar alternatives like the yuan, dirham, and Swiss francs. If you wait until stage 7, these moves become impossible due to capital controls. Stage 6 is the last window of freedom. 2. They moved out of government debt. Holding government bonds in a collapsing reserve currency is a disaster. You lose from inflation, you lose from devaluation, you lose from default risk, you lose from political manipulation. British government bonds lost enormous real value between 1945 and 1980. Dutch bonds suffered the same fate in the 18th century. U.S. treasuries will follow this pattern during stage 7. The elites of every collapsing empire abandoned government bonds early. Ordinary people held them until the end and were destroyed. 3. They shifted into cash-flowing real assets. Not just owning property, owning productive property, farms, factories, energy assets, logistics companies, rental properties, essential commodity production. These assets hold value regardless of currency because they produce something people need. A collapsing currency cannot destroy grain oil, steel housing, electricity, water, food supply chains. Empires collapse, but people still need to eat, live, and work. 4. They increased exposure to gold and commodities. Gold is not an investment. Gold is insurance. During every reserve currency death, gold was the only asset that preserved value, gained value, provided global liquidity, outperformed government bonds, and currencies avoided seizure when held abroad or in custody accounts. Central banks know this. That's why they bought more gold in 2022-2024 than in any year since 1950. They are preparing for stage 7. The question is, are you? 5. They followed the indicators, not the reassurances governments always say. Our currency is strong. This is temporary. We will stabilize things. They said it in 1949, in 1956, in 1967. They said it before Portugal fell, before the Netherlands fell. They say it now in America. But elites didn't listen to politicians. They listened to reserve flows, central bank diversification, gold purchases, debt rollover failures, global trade invoicing trends, diplomatic shifts away from the dollar. These indicators never lie. Modern parallel, your strategy for stage 6 and stage 7. If the dollar follows the historical timeline, and all evidence shows it is, then your plan must follow the same survival blueprint. 1. Hold 10-25% in gold or precious metals, physical or allocated storage, not ETFs. 2. Own productive real assets, income-producing real estate, land, businesses, energy, essential commodities. 3. Reduce exposure to long-term dollar bonds. They will be obliterated. 4. Establish some foreign currency exposure, Swiss francs, Singapore dollar, UAE dirham. Small allocations help reduce collapse risk. 5. Use stage 6 as your window. Before capital controls limit, foreign transfers, international purchases overseas, banking, cryptocurrency withdrawals, cross-border investment, governments always trap capital during stage 7. Move while you can. Outro. The choice that defines your future. A collapsing reserve currency doesn't punish everyone equally. It punishes the uninformed, the unprepared, and the trusting. But it rewards those who study history, act early, diversify widely, position globally, understand the cycle. History doesn't repeat. It rhymes brutally. We are entering the final decade of the dollar's global dominance. Stage 6 is beginning. Stage 7 will follow. The pattern has never failed. The question is not whether the collapse comes. The question is whether you will be ready or whether you will be among the millions who watch their life savings evaporate. If you take the lessons of Portugal, the Netherlands, Britain, and now America, you can survive stage 6 and stage 7. If you ignore them, you already know how that story ends.